The new stamp duty changes are now in place and property investors are panicking about the amount of money that we now have to pay in tax. For those of you new to property, stamp duty land tax, also known as SDLT, is a tax levied by the UK government on the purchase of property or land in England, Wales or Northern Ireland. It is paid by the buyer and the amount owed depends on the purchase price of the property as well as the type of buyer. For example, first-time buyers or homeowners will pay a lower amount in comparison to second home buyers or property investors and developers. Prior to 1997, buyers only paid 1% stamp duty tax on properties over £60,000, whereas as of right now, the minimum stamp duty paid by property investors is at least 5% of the property purchase price. And this also scales up depending on the property price bracket. And unfortunately, although all of this was brought in on April the 1st, 2025, this is no April Fool's joke. This is just the UK government. Now, before I move on to what the new costs exactly are and what the impacts are for property investors, I want to note some important pieces of information to people that are new to stamp duty land tax. First of all, when does this tax apply? Well, SDLT is due when purchasing a freehold or leasehold property, and that includes residential properties, commercial properties, and land. The second thing is thresholds and rates. You see, SDLT is charged on a tiered basis. The rate is applied to the portion of the property price that falls within a certain band. For example, a buyer purchasing a £150,000 property pays 5% up to 125 and 7% on the 25 grand between 125 and 150. Obviously, these are the second home or investment rates. If you are a first-time buyer, for example, or a homeowner moving homes, then this will differ. And the third thing is payment and filing. The buyer is responsible for submitting the SDLT return to the HMRC and paying the tax within a set period of time, typically within 14 days after the completion of this purchase. This payment is nearly always arranged with the help of your solicitor. Failure to pay this on time, of course, will result in penalties, so make sure that that is sorted with your solicitor. So let's talk about the changes. The autumn budget of 2024 marked a significant moment for the UK, as it was the first major fiscal announcement from a Labour government in 14 years. And the Chancellor announced an increase to the higher rate of stamp duty, raising it significantly from 3% to 5%, coming into effect the day after, which was the 31st of October 2024. This was bad enough and was a clear signal from Labour about their intentions for landlords during their term. But what they failed to mention was the further changes that were due in April 2025. And the new changes look like this. Up to £125,000, 5% in stamp duty. From £125,000 and £1 to £250,000, 7% stamp duty. From £250,000 then to £925,000, 10% in stamp duty. And then from £925,000 to 1.5 million, 15%, that's a whopping amount of money, and then over 1.5 million, 17%. That's almost a fifth of the purchase price you're then paying in stamp duty, which is ludicrous. And the way it works is there is a 5% surcharge that applies as a minimum to all the prices. Then each price bracket has an SDLT rate added. For example, £125,000 to £250,000 has 2% added to the standard surcharge of 5%, totaling 5% paid on anything up to £125,000 and then 7% paid on the portion of the price above £125,000 up to £250,000. In fact, to give you a better example, the breakdown of a £300,000 investment purchase looks like this. The first £125,000, which is a 5% rate, would equal £6,250. The next £125,000 between £125,000 and £250,000 would have a 7% total rate. So £125,000 times 7% is £8,750. And then that final £50,000, which is between the 250,000 bracket and obviously the purchase price of 300,000, is a 10% rate. So you've got a £50,000 there, times 10% is £5,000. So 6,250 plus 8,750 plus 5,000 equals £20,000 in total payable stamp duty for just a £300,000 property investment. Obviously that started from the 1st of April 2025 onwards. So the question is, how can you mitigate this additional cost? Well, first of all, many people believe that you can take advantage of stamp duty exemptions. And although this may be true, you can, they are very, very limited, and they are mainly held for certain strategies like property trading. But the majority of us investors that are doing buy, refurbish, refinance, or let's say flipping houses, well, we will not be able to access these exemptions. So exemptions isn't something that you can necessarily use to recoup this money. So you could buy 2 properties at £125,000 instead of 1 property at £250,000. The difference in stamp duty will look like this. 2 properties at £125,000 means paying 5%, which is £6,250 on each, so a total of £12,500. The alternative option is to buy 1 property at £250,000, which would equate to £15,000 in stamp duty. So the follow-up question is, how does that model fit in with your portfolio building plans? Is it worth doing that for the additional saving of £2,500? And number 3, which everyone will hate me for saying this one, but it honestly is true. But if you just get better at finding better property deals and negotiating more money off the price, then you won't need to worry about the stamp duty. I personally will not look at the new rate and let it taunt me. I will just accept the rate is the rate, and I'll think about how much do I need to pay for this property to make this a viable project with that stamp duty included. So based off everything I've said so far, what do you think the outcome will be? Well, I think this will drastically impact investors in high value areas. Obvious, right? But people in London or surrounding areas, they're going to be really impacted. And of course, therefore, I think those areas could well slow down in terms of the rate in which people are investing. I also think that areas with properties under £125,000 will only get busier as investors continue to chase lower value deals and a better return on investment. These areas include a large portion of the North, some of the Midlands, and some of South Wales as well. Yes, these changes are largely a negative for property investors. There's no way around that. But I don't actually think it will slow down the property market. That's my personal opinion here. I think the government's intention is to try and claw in more money and make property more accessible to first-time buyers by slowing down investors. But in reality, I think they'll just get more money in from investors, and I think everything will continue as normal. But who knows? I do not have a crystal ball, and that's just a personal opinion. All I will say is that change brings opportunities. If you can reframe this from a negative into a positive and just keep doing what you can to buy the best properties possible, well then it doesn't matter. What are your thoughts on these stamp duty changes? What are you going to do differently? Let me know in the comments. I hope you've enjoyed this video. Don't forget to subscribe, and well, I'll see you next time.